Well, what I'd like to do today is to review classes using past midterm exam sample. But one of the things covered in this sample includes some arguments discussed in lecture note 4, which is very brief note. So let me go over note 3 very briefly and then come back to this material. Okay. Here, it's in class material section of our portal. As you can see, you know that the many time series, economic and financial time series, exhibit kind of a trend. But what we learned is mostly we interpret that trend as something stochastic, okay, as opposed to deterministic time trend. So typical series like market capitalization, which is defined as share price multiplied by number of shares outstanding. That's market capitalization. So this is the size of Korean, let's say, capital markets. Okay? And the cost P. So the market cap and cost P appears to be moving very closely together, and accidentally, we have plots starting from January of 2000 up to the recent period. It shows sort of upward-sloping kind of trend, but we know that this is all by accident, by chance. Okay, so that's what we mean by stochastic trend. Also, if you look at some other typical series like market capitalization of, let's say, large capital stock or small cap stocks. You know, all those shows more or less stochastic trend, but those are kind of our impression. Okay? Usually, data shows, reveals sort of impression in one way or the other, but it's often difficult to determine whether in fact statistically these series contain stochastic trend. Okay? So what we learned was we can apply formal test to see if there is in fact a stochastic trend in this series. Before we get to that test, which is augmented Dickey flow test, ADF test, some more simulated data here. The one here, a typical random walk. So typical random walk is like yt equals to yt minus 1 epsilon t. This is typical realization from that process. Okay? So you may see some trend or mean reverting, whatever, but this is purely by chance. The second one, random walk plus drift. When we say constant term in a random walk, we don't say that as constant term. Instead, we call it a drift. So drift could be, let's say, mu and the same. So if it is positive, and it's more likely that you see some random movement going upward, right? If this is negative, then you might see more often, this kind of a stochastic movement. This one we say trend stationary time series, which is defined as something like alpha 0, alpha 1 time epsilon t. So time is the variable that has increment 1, 1, 1. Okay? 1987, 88, 89, increment is 1, right? So this time variable will look more like this whole thing, if alpha 1 is positive, right? So increment is 1, and if you have slope positive, then straight line, right? And then some constant and epsilon. So alpha plus epsilon t is typically stationary part, right? And this determines, let's say, this trend, right? This trend. So deviation from trend, so yt minus this one is deviation from trend, is simply stationary, right? So that's the stationary time series. So we know that, this and that are very different, right? This part is, of course, deterministic, right? And random part is only this one, whereas whole thing is random, right? So very different. But sometimes you may see, you are given this type of series and that type of series, and sometimes you may find it difficult to distinguish between these two. Right? But in many cases, you see from real data is more or less to this side, not this one. Very rare. Okay? But long time ago, before we understood this type of process, many people thought this is in fact the one generating many economic time series. That's been like 80s, 70s, 60s. But these days, we don't think this is the main model that generates observed Y. Instead, something more or less this. Random walk plus noise. That one is like yt equals to tau t and ct. Tau t equals to, let's say, random walk. Ct is, let's say, some stationary error. So random walk plus noise. So some data may be generated by this type of process, right? And this is one realization. So just by looking at this series and that series, may be difficult to distinguish which one is which, right? These examples are borrowed from Ender's book for 4 series with trends. Okay, here's one last series. This one is a simulated random walk process. So generated from this one without drift. Okay? We know that it's not reverting toward mean, right? But if you draw some horizontal line like this one, you may think that this one is in fact having cycle, right? Reverting to mean, which is wrong, right? So if you're given this type of realization, and if you calculate, let's say, autocorrelation or autocorrelation function, then at leg 1, it's about more than greater than 0.9 and declining very slowly, right? So you may think that this one may be, generated from AR1 process, which I mean like pi 1 by t minus 1 plus epsilon t. So you might think mistakenly, even though this is generated from this, instead you may think that that generated from this one. Okay? If this is really generated from a random walk process, this parallelogram has to be flat at 1. At 1. Flat. But because we are dealing with small sample, even though this is true data generating process, if you fit the model in this way, this number may turn out to be, let's say, 0.91, less than 1. Then you might see this type of pattern. So you might mistakenly think that data is generated from this process. So that's why we need Dickey-Flow test. So we are interested in whether estimated value for this one, let's say 0.93, is in fact the same as 1 statistically or different. If this is statistically not different from 1, then the process is that one, right? If this is in fact less than 1.0, then this is the right, correct process. Right? So we try to test the presence of unit root. Let me explain these two and then come back to the first one. Okay, so how to test it? Well, augmented Dickey-Flow test is to run a regression that look more like this one. So here xt is same as yt there. Okay. Some variable x. Okay. X is, we are suspecting that x is from either this type of process or this type of process. The difference is that one is non-stationary and this one is stationary, right? So we're trying to test which one is which. If you write it this way, try to forget about this term, okay? So again, let's say, what if rho equals to 0? If rho is 0, then what it says is x of t equals to mu plus xt minus 1, right? Plus epsilon t, which is that one. Left, top left, right? If this turns out to be, let's say, small negative, significantly negative, this one, then this one. Right? So we are testing with, this is a null hypothesis. Which says if this is the case, then there is a unit root, which is the first one, random walk process. If this is not 0, usually less than 0, then stationary time series. Okay. So we run this model and see if whether rho is 0. So apply least square method. So this is a data, known time, and data, right? So estimate this equation using least square and get the estimate. Okay? When you get the estimate, then calculate usual standard deviation and t statistic. Okay, t statistic. So if you run a regression, then you can calculate always t value, right? The important thing is the t value for the estimate of rho on the null hypothesis is not in fact distributed t distribution. Instead, something that looks more like this one. What is the main feature of this one? When we say t distribution, standard t distribution, it is centered around, let's say, 0. Right? So standardized t distribution is centered around t, and it is bell-shaped, right? Symmetric. But if you look at this one, 0 is right here. So most of the mass of this distribution is to the left from origin, right? It's very different. So if you calculated this one, a t value corresponding to this estimate rho, typical t distribution will look more like this, right? Centered around 0 and this way, right? So suppose t value turned out to be minus 2, 0, minus 1, minus 2. Okay? If usual t distribution have very fat, tail is kind of fading this way, but here in this case, this way. So p value is very large. Right? So inference could be very different. Okay? The reason I explained it previously, hopefully you remember it. The reason is under the null hypothesis of this one, case 0, okay? Actually, the usual t statistic is not defined. The distribution of t statistic is not defined. So this is kind of non-standard t distribution calculated from simulation. So first authors, Dickey and Wayne Fuller, they are the two statisticians who derived this type of simulated distribution, non-standard distribution, under the null hypothesis. Okay? So that's the formal way of testing whether there is a whether underlying series is I1, which is non-stationary, or having one unit root, or alternative hypothesis that look more like this one. Okay? The first one, so suppose you applied unit root test to GDP. So you take natural log to real GDP. So you get the series, and looks like it's rising over time. And you want to test whether it has one unit root, or in other words, difference stationary. So if you take log difference, then it's growth rate, and it becomes stationary series. If that's the case, if you want to test that, this is the right test method. And then you will find probably many economic and time series contains at least one unit root, requiring one difference to achieve stationarity. So GDP is one, consumption, investment, exchange rate, interest rate, CPI, industrial production, you name it. Many economic and financial time series contain unit root if you apply this test. If you have, let's say, one non-stationary series requiring one differencing to achieve stationarity, so integrated order of 1, or stationary series, so you don't have to take any difference to achieve stationarity because the series itself is stationary, right? So if you have this, whether it belongs to this class or that class, this is a right statistic, right? So suppose you have found two particular series, I1, belongs to I1. Okay. So number of foreign tourists in Tanzania. Suppose you have that time series that looks more like this one. Okay. And suppose you have our Kospi index that looks more like this one. Okay. Suppose you run a regression of Kospi index, I1, not return, just Kospi index, and number of foreign tourists in Tanzania. If you run a regression, what is it likely to happen? Suppose you run a simple regression, intercept and slope. Will slope turn out to be significant? If it is significant, what that means is, on average, if number of foreign tourists to Tanzania increases, our stock price rises. Is that the case? No, right? It appears to be, because coefficient says it's significant. And if you also check coefficient of determination, R squared, it may be like 0.62 or 0.80, very large number. Then you might conclude that, well, these two series are related, which in fact is a mistake, right? So that's the concept of spurious regression. So if you actually generate one random walk series from this computer and other random walk series from my office, from my notebook, so these two are totally unrelated to random walk series, right? Random walk, I1 class, right? But if you run a regression of this on net, I bet the slope is going to be significant. Why? I1 time series contains one stochastic trend, right? So it happens to be going this way, right? This one going that way. So you look as if they are moving together, right? So coefficient may look spuriously significant, which is a mistake, right? Big mistake. So how to avoid that situation? Because this is random walk, this is another random walk. So correct way of proceeding is to take first difference. So obtain this one. Another random walk, also take difference, get this one. So both are now this one, right? I0, after taking first difference. And then if you run a regression, one error to the other error, then you will see no pattern. Correct relationship. So that's the argument of spurious regression. Okay. There are some more detailed case. You don't have to remember, but you can. I just want to show this one so that later, if you encounter the problem of formally testing the presence of stochastic trend or unit root, in more general cases, you can refer to Dickey Fuller's original work, where the content is like this. Suppose you're suspecting that the YT is random walk or containing one unit root, and you want to test whether in fact gamma is 0. Okay, the same one we've seen from previous slide. So if this is null hypothesis, usual t statistic from least square, and then refer to this table, this distribution, where 95% cutoff value is minus 3.45. Okay? And 99% constant interval, well, that's minus 4.0. Making 1%. If you want to test whether, here's a time trend, right? Time. Suppose you want to test whether this one is 0, at the same time, no time trend. This is joint hypothesis, right? Joint hypothesis. So joint hypothesis. And it says calculate something called pi 3 statistic. How to calculate it is in the next slide. If you want to test whether this is 0 intercept term. This is 0 and this one is 0. 3 are 0 at the same time. So delta yt equals to simply epsilon t. You need to calculate something called pi 2 statistic. So joint hypothesis. And these are all simulated critical value computed from that kind of simulation. And also, your true model could be something like this one, excluding time trend, right? So you are not going to worry about it in this example. So in this case, you can test whether this is 0 or this and that are jointly 0. Or in this specification, we are dropping intercept term as well and just test whether this is 0. Okay. And depending upon your belief about true data generating process, there are various test statistics available, right? The reason why we are considering this different situation is the empirical distribution of test statistic like this one under various situations are actually depending upon whether you have in your model, whether you have this one or time trend. So even if you are testing gamma is 0 here, or gamma is 0 in this case, or gamma is 0, you see critical values are different. Right? Critical values are different. So if you look at this one, this is t distribution. Distribution shifts a little bit like this. If you move toward this way and that way, more to the left, and then longer tail. Okay. So we say the distribution under null hypothesis is sensitive to nuisance parameters. In this case, in this hypothesis, we call this one as, this is something we are trying to test, right? But how about this one? This one is another parameter to be estimated, right? But it has nothing to do with this hypothesis. So we call this one as a nuisance parameter. So the test statistic of this one is dependent upon the presence of this one or not. Right? So we have different thresholds. So if you happen to face, this kind of more serious test situation, you can refer to this. But in our case, just remembering this one is okay. Okay, testing whether this one is 0 or not. Okay. A pi statistic, just in case if you are curious. In the previous page, we had pi 1 statistic through pi 3 statistic, right? The way we calculate pi 1 to 3 statistic is you run a regression, and there's a number of restrictions. So by number of restrictions, what we mean is, in this case, 1. In this case, number restriction is 2. Right? Gamma is 0. A2 equals to 0. So 2 restrictions. Pi 2 statistic, there are 3 restrictions. Right? And 2 restrictions. Right? So that's the number of restrictions. And restriction is restricted to what? Value 0. If you put value 0, A2 equals to 0, then this one drops out. That's the restricted model, right? So in this case, restricted model is this one is suppressed and that one is suppressed. So you have full model and restricted model. Okay? So you run 2 sets of regression, then you can get fitted residual from restricted model and unrestricted model. And then this one, SSR, stands for sum of the squared residual. So compute epsilon t hat and square it and add them all. That's sum of squared residual. Okay. Sum of squared residual from restricted model, unrestricted model. Take the difference, divide it by number of restrictions, and again this number and number of effective or usable observations, and K. Where's K? Number of parameters estimated in unrestricted model. So these are all defined, then you can calculate version 1, 2, 3. This is borrowed from a seminar paper by Nelson and Placer in 1982, so a long time ago. And going back to this equation, try to remember the intercept term is expressed as A0. Coefficient to let the level is gamma, and coefficient to time trend is A2, right? So A0, A2, and gamma. A0, A2, and gamma, right? So Nelson and Placer tried, using annual data for the United States, tried to see if whether real GDP is in fact contain at least one unit root. So null hypothesis whether this one is 0. Okay, coefficient gamma, right? And they tested using annual data for real GMP. This is t value, but if you read actual Dickey-Fuller distribution, this one is in absolute value too small. So cannot reject the null hypothesis of one unit root. So there is one unit root exists. Nominal GMP, real and nominal, still these are too big. And industrial production, the same. But if you look at unemployment rate data, this number gets now very small, right? Very small. So there is evidence that minus 0.294 is not 0. It's a significantly negative number. So concluding, unemployment rate is, if you look at long annual historical data up to 1982 in the United States, it's stationary time series. That's what they found. P's are number of lags in the augmented expression, and this column is simply 1 plus this number. So actually you are testing whether there is a unit root. Is the same thing as like whether this one is 1, right? 1. Less than 1, less than 1, less than 1, less than 1. But statistically, these are 1. Statistically, this is less than 1. That's what these scholars found. The last point in this slide, this is often difficult, you know. You see, when we look at our real GDP sequence or GDP sequence of the United States, we all know that we have kind of dip in the series during the period of crisis, like subprime crisis in the United States and global financial crisis in Korea and so on and so forth. So data is basically what it says is yt equals to AR1. So 0.5 satisfy this condition, right? So stationary time series. This is stationary time series. And this is also stationary time series. But there is a kind of d of L is a dummy variable taking value of 0 up to here. And then from here, value of 1. So there is no intercept term, right? But after this period, this value is going to be 1. So new intercept, right? Whole thing. So AR1 process, here AR1 process, but there is a kind of shift in the structure, level shift. Then, so if you are given this series without knowing this possibility, level shift, if you apply ADF test to this sequence, then what is likely to happen is you are likely to find at least one unit root present in this series. So ADF test will be biased toward finding unit root, even though the real series is a stationary series, but having level shift. So you may or may not see, in real example, this type of situation, but this is certainly possible, right? So this is the case, emphasized by Perron. Here's another example. In this case, this is random walk. This is another random walk, but there is a one pulse. So this DOP is defined as all 0, but at time here, value, some value, and then 0. So DOP is a one-time single pulse. So 0 and plus and 0. Okay. So what's the similarity and the difference between these two series? This one and that one? Look similar, right? Look similar. And in both cases, probably you are more likely to find the unit root. But here, most of the time, random walk. Here, most of the time, stationary time series. There is one time, level shift, and there is a one-time pulse, right? Outlier. So, because you are faced with this type of series of data, you want to test whether there is, in fact, a level shift or one-time pulse. So here, I cited one, just testing whether alpha is less than 1 or equal to 1. So testing whether y is containing unit root, where you are suspecting the level shift, right? So you create dummy D of L. So if so this is the period. So tau plus 1, you are suspecting there is a permanent level shift. So it's taking value like 0 all the way through, and if you pass through tau, then it all ones. Right? So you create dummy variable and run this regression and then calculate t value, and Perron, in his paper, he has the table that shows simulated distribution on the null hypothesis where you might have this type of level shift. Okay? And so if you actually treat this one explicitly like that and referring to particular table for inference, you are more likely to find unit root. So the stance is like this. When Nelson and Placer revived the idea of Dickey and Fuller, saying, well, trend stationary assumption, which has been popular before 80s, Nelson and Placer showed that the trend stationary time series and assumption, that kind of assumption is not reasonable. Instead, more reasonable conclusion is the presence of stochastic trend or having or containing one unit root. So that's the message. Okay. So that has been popular. Okay. And after 6 or 7 years, after Nelson Placer's work was published, now Perron is taking the other position. He is advocating, some of the theories, like this one, follows this type of stationary time series. So you might guess by seeing this example, stationary and stationary, but if there is a level shift or regime shift, then you might find sort of trend. So ADF test is usually biased toward finding unit roots. And we can easily conjecture that many structural breaks or shift of regime change over time, right? So he's more inclined to this one. So by now we know that if stock price follows random walk, then what is the best forecast? Best forecast for YT tomorrow is the current value, right? Current value. Not predictable, right? Future value. But if data is generated from this one, if stock price is generated from this one, it's predictable, right? Predictable. Or it is generated from, let's say, YT. There is some stationary part. It is predictable, right? So, as it's a joke, but if you are a researcher in finance, and if you report, stock prices, and nothing is predictable. If your assertion is that, then who's going to ask you a question? Who's going to ask what is the stock price next year and paying you the big money? No one is going to pay you, right? Because it's not, if it is not predictable. If it is predictable, then you are in business. So someone wants to find some evidence against leading view in stock price, and this is one of the kind of a little bit of political things going around in academic society. Okay. So that's all I have to say. We've seen this one already, right? So in lecture note 4. So I'll show you why I mentioned this material. Okay, this is the midterm exam I asked last semester. first semester last year and see if you were here last year, a year ago, then think about whether you can answer it. Okay. Autoregressive process, right? Stationary time series. The first question is, can you calculate conditional expectation and its variance? So concept of conditional and unconditional thing, right? So conditional, what is conditional? Something is known at time t. Right? Something is known at time t. So if you calculate expectation here, this is known, this is not known, right? So naturally this is the answer. What is the conditional variance? Well, taking conditional variance on both sides, right? And because this is already known at time t, not varying, this number fixed, right? So the variance is 0. So this one only. So simple as that. The second question was to ask you, the simplest calculation we can think of. So what is the covariance? The covariance is xt minus 1 is the same as xt minus to be exact, these expressions are the same thing. Right? Covariance is defined as deviation from their means, okay, and cross product and taking average. Right? But we know by now, moving average process, regardless of the value of theta, it is stationary, right? Because memory is short, just one period. So we know that taking expectation on MA1 process, expectation is 0. Right? So this one is 0. And because this x is stationary, this and that are the same, right? T minus 1, t, same expectation, right? So this is 0 and this is 0. So now these two, right? So expectation of this times that. So expectation, what is x of t? Epsilon t plus, minus or plus? Plus. Okay. Theta epsilon t minus 1. What is x t minus 1? Lagging 1 period, right? So epsilon t minus 1, theta epsilon t minus 2. So can we calculate expectation of this product? Well, because usually epsilon t is a IID mean 0 sigma squared, right? So covariance is a 0. So, covariance are 0. This product, right? The only thing left is this one. Theta epsilon t minus 1 squared. Right? So it has theta epsilon t minus 1 squared plus 3 more terms, but those are all after taking expectation 0, and this one survives, right? So what is this value? Theta sigma squared. Right? Theta sigma squared. So the answer. If you're taking one more leg, then there is going to be no overlapping. So 0. So in this sense, memory lasts 1 period. No more than 1 period. Right? short memory process, moving average process. Okay, this one is a sort of a little general question. You know, we can bring any kind of time series here, and presumably containing one unit root, and ask the class to describe briefly how to test it formally. So you can say, let's say you want to test whether rho is 0. So you calculated rho, let's say minus 0.12, along with t value. Suppose you found 2.02. I'm just making it up, okay? And this is 0, and this is standard t distribution. But correct distribution is this one. So this is distribution under the null hypothesis of unit root. This one. This is standard t distribution. So I wanted to see if whether you can indicate you need a proper distribution, this one, not this one. Okay. So some people say, let's say, well, if test statistic was, let's say, 2.02 here, this is what we call p-value. P-value is smaller than the correct one, right? So your inference could be different. Okay? So if you find the evidence toward this direction, if you found this number very small, so something here, then under even correct distribution, p-value is very small, right? So there is evidence against the null, right? Evidence against the null, right? So finding or rejecting unit root process. But if you are moving toward this direction, in terms of t statistic, you are supporting this one, right? So if p-value is very small, then you are rejecting it. If p-value is big, then we are supporting this. Right? So this is the minimal thing I try to see from your answer sheet. But this is much of a better presentation of your answer. Question number 1-4. We've seen in note number 4 that there can be sort of pulse upward or pulse downward, right? In a GDP sequence, you see this, and then pulse downward, and then random again, right? So in that case, even if you are finding d equals to 1, which is different stationary time series, still you have to look at epsilon t, residual, having, let's say, big positive value or big negative value, right? And our remedy discussed in class is check your fitted residual, okay, and see if there is anything big, right, above or below, and try to introduce dummy variable that explain that particular period. Then usually fit gets better, and one of the reasons why we introduce dummy variable in such circumstance is that if you ignore dummy variable when you actually need one, the estimated coefficient for this part could be biased. We can show it, algebraically. Sometimes that bias could be very big. So if you find something maybe referred to as outlier, then introduce dummy. That's the simplest remedy. I hope that you can calculate this quantity. So taking one lead, one period forward, so find expression for xt plus 1, take conditional expectation at t, and then lead one more period. So write it in terms of t plus 1, okay, and then plug it in and you'll find actually this is the answer. So conditional expectation at time t. Any example here? Let's say natural log of stock price index, and here it shows actual during out of sample period, and this is simulated mean and upper bound and lower bound. And the question asks how to get this result using bootstrapping and Monte Carlo. So if you find appropriate ORIMA model for the data using in sample, right? In sample, now you are ready to generate using simulation method either bootstrapping or Monte Carlo. Right? So it's actually generating the future path using the model, right? The question is whether you can distinguish the difference between these two. Okay? Bootstrapping method, you remember that when you estimate ORIMA PDQ model using in sample, you get fitted residual, right? Use fitted residuals as a population. So when you try to generate future, so epsilon t plus 1, t plus 2, t plus 3, you draw numbers from that fitted residual, random, in a random fashion. Right? That's bootstrapping. Or using Monte Carlo, well, when you have fitted residual, you may assume that that residual is distributed normal. So let's say you assume normal distribution, and then fitted residual, you can calculate mean, probably 0, and you can calculate sigma squared from fitted residual, right? Then you can always draw numbers from normal distribution with mean 0, variance sigma squared. So draw numbers and treat that as if it is epsilon t plus 1, and another one, epsilon t plus 2, epsilon t plus 3. Right? So making assumption about the distribution of fitted residual, no assumption whatsoever. Right? So that's the difference. Yeah, you can recursively do it, and the question was how to, and where to draw this, right? And this one and so on. Okay. The next question was asking whether you have understanding about what it means squared error. So, mean squared error is first calculating, let's say, one step ahead forecast. So you have in sample, you have a model, and you can generate one step ahead forecast, right? And in out of sample, you have actual data, right? So you can calculate the difference. So record it, that difference, and then move toward next period. So this is now new in sample, fit the model, and generate forecast. Okay, and compare with spared actual value. Take the difference and record it. So you do it several times. Okay? So how many times? N times. And that's the difference, right? And sum it all, square it first, deviation, actual and your forecast. Square it, sum it over, divide it by n. So that's the variance, sort of variance, right? Mean squared error is a variance. We're looking forward, right? Future. And you can do the same thing. The k is tail ahead. So if k is 2, generate 2 step ahead forecast and compare with spared actual value there. Okay. The next period, fit the model again and generate 2 step ahead forecast and compare with actual. And you do it several times. How many times? N times. Okay. So you have a model, let's say, P and Q combination 2, 1 and 2, 2. And if you compared mean squared error for these two competing models, then you probably want to pick the one with smaller mean squared error, right? That's better fitting model. So that's the first question. The second question was to test whether the model 1 versus model 1 is preferred to model 2. Right? So there are several different ways of implementing Diebold and Mariano test in 1995. But basically, this is the residual forecast error from model 1 and competing model 2. And introduce any function, let's say square function or square root function, you name it. So any g function, arbitrary function, transform it and take the difference. And if you have, forecast error up to h number of them, then, if model 1 and model 2 are in fact the same, then this difference should be very small, right? Very small. But if model 1 is better, in fact, then this number is going to be smaller, right? So smaller number minus something, so this could be different from 0, right? So you calculate this statistic and refer to their appropriate, distribution for inference. So that's the idea. So you can say, because in implementation, a g function could be set differently. So I just asked the general idea about what we mean by Diebold-Mariano test. Then calculate forecast errors from competing model, and then transform it using some loss function. G function is technically called loss function, and then take the difference and then calculate the average difference. Okay, and if one of these two models generates small error in terms of test result, then that model is preferred. Okay, the second questions and some related questions, we've seen from Excel worksheet how to calculate this EWMA recursively, right, in practice. And we know how to calculate annualized standard deviations as a volatility measure. And this is typical GARCH-1-1 setup, and these are EWMA. And asking advantage and some disadvantages of this. And here is the advantage part and disadvantage part. So you can add more, but minimal thing, EWMA measure can compute always. It's not model, so you can compute it anytime you want. Right? But sometimes, parameter may not be estimated. Right? So in that case, cannot calculate it. So, and also in sample performance, according to previous study, it's very similar to parametric model like GARCH. So it resembles, right? But by now we all know that because it's not a model, it cannot generate forecast. Whatever the latest value, and that's your forecast. And of course, the big advantage of econometric model is that you can use it to construct forecast. And this one is a little bit twisted, but it shows, it asks how to check whether your model is in fact adequately set up. Whether your model, let's say GARCH-1-1 is reasonable. Okay. Actually when you estimate this GARCH-1-1 model, think about what would be the output from your estimation. And I mentioned, but I didn't show you exactly how to estimate it using maximum likelihood estimation because it's more complicated. So I just skipped part. But if you actually applied maximum likelihood estimation from using EBUS, XT is single univariate series. This is your data, right? This is mean equation and variance equation. Okay. What are the parameters to be estimated? Well, this is your parameter, mu in a mean equation. Okay. X of t could be stock return. Okay. Pi 1 is parameter to be estimated, right? And psi t and sigma t or epsilon t is conditionally normal, right? Is this to be estimated? T run from 1 through cap t, right? So this is not really estimated. What is estimated is this one. So where you estimate this, and that. Then given initial value, you can recursively calculate this one. Right? So actually what you're estimating is 1, 2, 3, 4, 5 parameters. Okay? So when you estimate parameters, so you know this one and that one, then you can calculate this one, right? Fitted residual, right? Fitted residual. So you have fitted residual from GARCH-1-1 model. And if you look at that one, usually we say residuals are having mean 0 and sigma squared is the variance, right? So this is upper bound and lower bound, and fitted residual hopefully mostly lying within this band, right? So if you check your fitted residual, and if this is in fact a model, then you will see more of these features lying outside this band. Why? Because epsilon t is defined as not just, unconditionally standard normal. It is multiplied by sigma t, which varies over time, right? So what you have to do is, using this relationship, you compute fitted residual. Now, then you have this one calculated again, and divide this one by sigma t. Then what you get is this, right? Psi t hat. And check psi t hat and see if it lies within this band. So we call it, and technically, standardize epsilon t using sigma t. Then what is left is psi t, which has to be showing no conditional heteroscedasticity, right? Standardized residual, which is psi t, should not show any conditional heteroscedasticity because, psi t is assumed to have variance 1, constant, right? So let's take a look at how I described it. So epsilon t divided by sigma t, you computed, is a proxy for psi t, and you can check whether it looks more like this thing is standard normal. Okay. How to check whether it is standard normal? Well, standard normal, feature is the standard normal as mean 0, variance 1, right? So more or less, epsilon psi t minus 2 plus 2. All those psi t should lie between minus 2 and 2 about 95%. Right? Sometimes it could go outside that range, but chance has to be less than 5%. Right? If 2 and minus 2 are threshold. So that's the way we check it. Okay, Garch 1, what was the question? Suppose monthly return volatility is modeled as Garch 1, process above, and we found that's indeed a reasonable description of the data. Okay, what is the baseline volatility of Garch 1? Illustrate conditional volatility or variance, and sigma squared, and volatility forecast. So actually, it's showing this green lines, light greens. That's Garch volatility, sigma t, annualized. And this horizontal line is the one computed from this one, and annualize it and taking square root. So same unit, right? So this is flat one. So intercept term divided by 1 plus 2 coefficients. And the forecast, if this is the key in this presentation of the volatility forecast, if you if you draw this line, sigma squared, or sigma, in this case sigma, and if that was a sigma t, the last observation, your forecast should go toward baseline volatility. If you accidentally ended up here, then your forecast has to be toward this direction. So in a gauge model, when condition is all satisfied, the forecast will go toward long-term average, or what we call baseline volatility. Okay. So in this case, it ended up slightly below this horizontal line, so it's moving that direction.
So do we have to draw pictures like that one?
Yeah, you can illustrate it. You can say here is a sigma t, sigma. Okay, so let's say this is 0 and this is sigma, and you can say this is sigma t, and you calculate this one using the formula like that, and then your forecast is toward this direction. Okay? So if you happen to stop right here, then your forecast is going to be that way. Because it's stationary, the volatility is stationary. Then exponential gauge is showing this result, and it says whether you understand the motivation of this E-gauge model, where E-gauge model is capturing leverage effect, right? Something called leverage effect. By that, what we mean is people tend to behave or respond differently depending upon the nature of a shock. Whether it's negative shock, people tend to be more nervous, responding more nervously, right? So we increase volatility. But if it is positive shock or good news, then people may respond less, right? So what is then, well, this is the psi t, elect one period, and this is omega, right? The last time I mistakenly said this is positive, but this is usually negative coefficient, omega. If there is a leverage effect, this term is usually negative. Then this is the output. And the question is, can you find where is Waldo? Do you know where is Waldo? A very complicated picture, and there is one guy hiding. You're finding that guy. It's my favorite when I raised my 3 kids. And I purchased that book, and it has a very colorful thing, Gullivers and Oz of Wizard, many complicated picture. There's one guy hiding, Waldo. We are trying to find him. And here is Waldo. Where is it? Where is he? Here. So you need to find which term? This one. And you can read up, those are the coefficients. Right? And so this is the coefficient corresponding to that. Then you need to find what is the value correspond to this parameter, or this parameter, this parameter, this parameter. Very difficult to see it because E-views express this equation slightly differently. So not exactly this one. what EBUS is trying to fit is explained right here. Log sigma t squared equals to constant and etc. etc. So which one? Which one? You know, you don't need a genius here. It's what we done here already. You know, what is psi t? This one divided by sigma t, right? So, looks like gauge t is sigma t squared, right? Gauge t minus 1 square root and epsilon t minus 1. So this is in fact, so what is your answer? Omega minus 0.219. This p-value is about 10%. So at 5%, this is not significant. At 5% significance level, this is not different from 0. But if your tolerance level is about 10%, well, this may be interpreted as negative value. This one, threshold arch or leverage effect, we learned that we can introduce, simply dummy variable. The taking value equals to 1 if there's a surprise, negative surprise, or 0 otherwise. If lambda 1 is non-zero, then it will capture the leverage effect, similar to E-arch. And this one is about a single index model. Okay. So if your covariance matrix gets bigger and bigger, but still you want to introduce, kind of feature like a conditional volatility, then multivariate gauge class model is not your answer because very difficult to estimate, so not feasible. So something like this looks awful, but the idea is very simple. All you need is, this main diagonal is computed from this formula. So, for instance, first one, this plus that. Second one, this plus that. So along diagonal, main diagonal, you have this and this term in that diagonal. Okay. The covariance side, this term doesn't appear, so all you need is this term. Right? So J 2, 1, n minus 1, 1, n 1, and sigma m's, right? And symmetric. And all have m sigma m squared as common, so you can factor that out. Right? So you can find a simpler formula. But the thing is, this is what we mean by single index model. Right? The key element is this. This one, and this one. Okay? Then you can fill out this whole thing as this one. How to analyze volatility? Well, square root rule, right? So number of trading days. So if daily data and number of trading days are 255 days, then square root 255 is multiplied. But if you're working with quarterly data, then trading days, well, there are only 4 quarters in a year, right? So square root 4. If you're working with monthly data, then standard deviation computed from monthly data multiplied by square root 12. That'll make it annualized volatility. So, do you miss midterm last year, or if you were here last year, would it be better or worse? Or if you think this is reasonable, then you missed opportunity last year, because exam will evolve. This is what I mean. This is what we call family history in Korean. Family history, or exam history. This is part of exam history. Okay. Recently, there has been problem of having group of people who have history of previous exams and an answer key, or the other group doesn't have one. Okay. So that's not fair, right? So I'm making it open, even to our, those OCW viewers. But that doesn't mean that you will see the same question this Thursday, right? Exam will be, evolving. So even if I'm asking something very similar, the terms and, looks may look a little different, right? But even that, in that case, so don't panic. And materials are something very similar to this one. So focus on, try to review our lecture materials. You don't have to go back to Ender's book. You don't have time for that until Thursday. So focus on our lecture note and the examples we did during the class. And then, more or less, you will see something very similar to this one from your midterm. Any question? This is simplest term, right? I erased it, but here what we've seen was yt equals to tau t plus ct, right? Random walk trend plus some noise. And noise could, let's say noise term is suppose this is the way yt is generated. And, this is, of course, I0, I1, right? You need first difference to make it stationary, right? This one, if the sum of these two are less than 1, stationary, right, usually. So this is I0, okay? So when you add these two, then usually, high order term dominates. So usually this becomes I1. So suppose you are given just yt, not knowing this, okay? And you run a regression of this one, simplest case. Testing for 0, right? Then actually you are calculating mostly this part, not this part, right? In this residual, these effect is going to be found. Right? So these effects were actually serially correlated. Right? So instead of testing it in this way, you're adding, let's say, pi 1 delta y t minus 1, pi 2 delta y t minus 2, to capture any remaining dynamics in the short term. That's the augmented part because of this. So if this is actually exist, then simply YT is the same thing. Then you don't need this one, right? Good question. Any other question? Okay, that's all I have to say. Then we'll see you on Thursday, 2:30 here. Okay, thank you.